Good afternoon, everybody, and welcome to today's webinar. My name is John Else. I am a partner at DJH Corporate Finance. We specialize in selling businesses on behalf of our clients. And at all times in a transaction, we look to maximize value and to minimize stress. And that is the subject of our presentation today. We've got a great lineup of speakers. I'll be kicking things off, then handing you over to my colleague, Lewis Pearson. We'll then hear from Rebecca Jones, who is a corporate lawyer at Beswicks. And then we'll be hearing from Terry Hughes of the Wealth Experts team, who'll be looking at how we can invest the proceeds that we will generate through a sale process. So in terms of a bit more detail on today, I'm going to look at preparations for sale. Lewis is then going to look at some different sale options. We'll look at different deal structures and the process and timeline of a typical transaction, if there is such a thing. Rebecca will then take us through the sort of the main points around the due diligence process and give us an overview of the legal side. And then Terry's going to talk to us about the work that his team can do in investing sale proceeds to protect the wealth created. And then at the end, we've got time for some questions and answers. So if you do have a question, please pop it in the chat box, and then we shall pick it up right at the end. So, preparation for sale. I'm going to cover timing, succession planning, building an advisory team, pre-sale planning, and the importance of good, timely management information. So we're often asked as corporate finance advisors, when is a good time to sell my business? Not an easy question to answer, and there's a different answer for every client that we come across. But it's often a combination of several factors: the personal drivers of the business owner, the life cycle of the business, and looking at the wider market in which the business operates, and also what's happening in the wider economy. So personal drivers, a big one that we see often is a retirement plan. So we work with owner managers who've built a business over the course of their career, and the sale of that business is a core plank of their retirement plan. But we don't just work with retirement sales. Often we see people who've built a business and they have created something of value, and they want to realize the value that they've created in that business and perhaps go on and do it again, either in a similar field or something totally different. We also talk to people who have taken a view that they've taken their business as far as they can within their own resources, within their own capabilities, and they think that the next phase of the business's growth is best served as part of a larger organization. So often we are working with people to find that, that next step for the business. In terms of life cycle, probably nearly always we'd say that if a business is in its startup phase, it's too soon to sell. There will always be some exceptions to that, but we wouldn't really advise to sell a business during a startup phase. Equally, we wouldn't advise to sell a business when it's right at the top of the growth curve, and certainly not when it's in decline. We'd always recommend that there is growth left in there for the next buyer. And then in terms of the wider economy and the market, again, that is different depending upon the sectors that we're in. Now, when we're running a sale process, we would always look to bring in a number of interested parties and create what we would call competitive tension in a process to increase the value. Now, if we entered into a transaction in a depressed market, we may not get that degree of competitive tension. Say, for example, we had a client who was exposed to discretionary consumer spending, say a casual dining business. Given the pressures on that sector currently, now might not be the right time to put such a business up for sale. So we'd consider all of these factors before we push the button on a process. That said, there's always exceptions, and we would like to think that we would always find a good home for a good business, no matter what was happening in the wider economy. And clearly, if someone is looking to retire, you can't wait forever. So I think it's important to start planning for that sale sooner rather than later. We work on transactions all the time, and a typical life cycle of a deal can easily be 12 months. We work on some that are shorter and some that can go on much longer than 12 months. And then, of course, at the point of sale, there is often a handover period and potentially linked to financial aspects of the transaction. And that can be 12, 24, or even 36 months. So, it could be a 2, 3, 4 year process from the point of going to market to transition away from the business. So the sooner you can engage with advisors like ourselves, the better. We often work with businesses, a couple of years before we actually make the move into the market to prepare the business for sale. We really understand the business, get to know the client, get to know the drivers. So it's never too early to get us involved in a process. But equally, I'd say it's never too late to get us involved either. We're often parachuted into situations where an offer's been received, or even if an offer's been signed. And even in those situations, having an advisor alongside you, someone that's experienced in these types of transactions, can add value, can increase value, and will help to minimize stress. Moving on to succession planning, if a business is seen to be over-reliant upon the current shareholder team, that is seen as a risk factor from a purchaser's perspective. Worst case basis, it can be a showstopper altogether, but at the very least, it would probably go to value and also potentially impact the amount of money received on day one versus monies received over a period of time as part of a deferred consideration or earn-out structure. And that's something that Lewis will talk about shortly. So we're looking to make it as easy as possible for the buyer to buy the business and it to become part of their business. The worst thing for a buyer, or the concern for a buyer, would be that on the other side of a transaction, key customer relationships or key supply relationships fall away because the exiting shareholders are no longer there or have taken a back seat. So we would say start planning for succession today and look to build a team, look to build a business that is capable of functioning without the main shareholders. And if that means transitioning key customer relationships, transitioning supply relationships, then look to get that in place sooner rather than later. Next point is around the advisory team. Selling a business is a specialist area. So I think we would always recommend that you build a team around you that can help you maximize the value in the business and take away some of the strains and stresses that are associated with selling a business, whether that's the corporate finance advisor, whether that's an experienced corporate lawyer, or whether that at the end of a process is somebody who can help you invest the wealth that has been created. As corporate finance advisors, we are experts in finding buyers for businesses, whether that's a strategic trade buyer or a financial buyer, such as a private equity house. We run competitive sales processes to maximize the value, to generate interest, to have a number of parties that are keen for the business and use that leverage to drive the price up. And we are with you every step of the way. We sit with you in that initial meeting, and we're there at every stage of a transaction, right through to the successful completion of that transaction. We're here to secure the best possible outcome for you by maximizing the value and minimizing the many risk factors that are inherent in a corporate transaction. Selling a business is a highly emotional, highly personal thing. it's time consuming, and it can be disruptive from the day-to-day of running a business. But putting an experienced team around you who can lead those negotiations, who can be the buffer between you and the buyer, and who can ask the difficult questions without making it personal, will help to minimize the stress, and will also mean that you, as a business owner, can focus upon running the business. Because the worst thing that can happen during a transaction, one of the worst things that can happen during a transaction, is performance starts to slip. And then that leads to a discussion around value. And that is not something that we want to see. So I would say build an advisory team around you, use a specialist corporate finance advisor, use an experienced corporate lawyer, and at an appropriate time, engage with a specialist wealth management provider. Rebecca will talk to us in a bit more detail about the legal process, but the negotiation and drafting of documents such as a share purchase agreement or an asset purchase agreement is a specialist area. And again, we'd say that let's leave that to the experts. That's what they're here to do. So in summary, a good advisory team will limit the distraction caused by a sale and allow the business owner to carry on running the business, because what we don't want to see during a transaction is a drop-off in performance. Pre-sale planning, I think Rebecca will talk a bit more about pre-sale planning in her section, but again, this is having an experienced team around you who can identify and address issues up front that may have an impact upon value further down the line. That could be something like an over-reliance upon a small number of customers. Now, is there work that can be done to broaden the customer base? Similarly with suppliers, if we are reliant upon 2 or 3 key suppliers, can we broaden our supplier base? Other areas of focus are often legal aspects. Have we got any ongoing claims against the business? Or HR, do all our staff have up-to-date employment contracts? Are we paying staff in accordance with national minimum wage? That kind of thing. And then finally, touching upon management information. Now, as a firm of accountants, we would always say that it's best practice to produce timely and meaningful management information. It will help you run your business better on a business as usual basis. You'll know where you've been, you'll know where you are, you know where you're headed. If there are any issues, you can spot them early and you can put a plan in place to change them. So that's, in the day-to-day running of your business, we would say great MI is always a great idea. But in terms of a transaction, it will always make the financial due diligence process easier because the information will be there and available to us. The buyer, during the course of a process, will want regular updates upon the performance of the business. And having that MI available means it's there at the click of a button. And as I said before, one of the things that we do see that can impact value during a transaction is performance slipping. So if you can spot that early enough, then we can work together to put it right and maintain value. Right, so at that point, I'm going to hand you over to my colleague Lewis, who is going to look at sale options and structures.
Thanks, John. So, hi everyone. My name's Lewis Pearson. I'm a director in the corporate finance team here at DJH, and kind of the key part of our role is to help business owners with their exit strategies. So we wanted to talk through kind of 4 of the most common sale options that we see. So the first one being a trade sale. So the trade sale is actually probably the most common option of all these different transaction types, and that relates to the sale to the business to someone else operating in the market. So that could be a competitor, but it could also be a supplier or a customer. And the rationale here for these types of buyers is that it can increase their market share, it can help them diversify into a different area, but they can also generate synergies by putting the 2 businesses together. So whether that be performing better operationally, but also financial aspects as well. I think with a trade sale, one of the most common questions that we get asked is how do we maintain confidentiality during that process? Business owners that we speak to can be a little nervous about potentially talking to their competitors, their suppliers, even their customers. The key part of our role as an advisor is to help manage the flow of information so we can help hold back commercially sensitive information until the appropriate time. And the information memorandum, which is a document that we'll talk about in a little more detail shortly, we only ever provide that under a non-disclosure agreement. So our role as an advisor is to help maintain that throughout the process. Lastly, in terms of a trade sale, John's touched on kind of competitive tension and how that can drive value. So the creation of that during this process through different parties can help drive the value through this exit route. And with a trade sale, it can be one of the best exit routes for a clean break, but there would likely be an expectation that there is a handover period from the vendors. So we'll also touch on a management buyout. So that relates to the sale of the business to the existing management team. So this can be a good option for continuity. The new owners are known internally and externally, and it can also be an excellent way to reward key management for their role in the business. We do see that kind of it might not be an option for all parties. Management may not have the appetite for risk. And in terms of pricing, in terms of like the price of the transaction value, we do see that trade may usually pay more. There is a limited competitive tension in that process. And what it can mean for the seller in a management buyout scenario is that they can be part of the funding solution. And what we mean by that is they can be longer deferred consideration periods in terms of how the consideration is received. So the third option we're going to talk about is private equity. So these are financial buyers. So they may be looking for an investment into a business, and typically they look for a return on their investment over a 3 to 5 year period. So we can run kind of processes where we're considering all of these options in tandem, and a private equity route is something that could be used potentially to help fund the management buyout side. So where it can help kind of bridge a gap in terms of the consideration value and in terms of limiting anything on the kind of deferred process. What we do recognise is that it's not suitable for all businesses or potentially even all sellers. There can be an expectation to roll an element of some of the proceeds into a new company, but what that does allow is the opportunity for a secondary exit down the line. So sellers can potentially kind of take some consideration now in kind of for part of their business, but then with the secondary exit, they could have a bigger gain in the future. And the last sale option that we'll talk about here is an employee ownership trust. So that's the sale of a majority stake of the business to its employees. So the key advantage in this route is that there's currently no capital gains tax on an employee ownership trust. Similar to a management buyout, it has its kind of the consideration structure can be limited in terms of the day one cash, and then there can be an element of deferred paid over a number of years. So in terms of these different options, we kind of briefly touched on the different structures. So in terms of day one proceeds, deferred consideration and an earnout. And we wanted to touch on a little bit more detail in terms of what we're seeing in the market across these aspects. So we're definitely not seeing in any transaction that 100% of the proceeds are paid on day one. Typically, that's normally between 60 to 80%, with the balance of the consideration either as deferred consideration or as an earnout or a combination of the two. So just for clarity, deferred consideration not linked to the future performance of the business, so does provide more certainty, whereas an earnout would be dependent upon the future performance of the business and could be linked to revenue, profitability, or the retention of key people. Our role as advisors is to kind of maximize the value of a transaction and also the certainty of that value. So clearly, the more day one proceeds could be considered more certain for the vendors, but then also how we manage the deferred consideration and the earnout aspects. And we do have experience in negotiating structures to build a degree of tolerance into earnouts to ensure that they're not kind of all or nothing ratchets. We thought it'd be helpful to also kind of touch on the sales process and the different steps that it involves. So I know John's already touched on a lot about kind of the process planning and the pre-sale planning. So the process planning here is where You're picking the team to support on the transaction, you're ensuring everyone's working together on the goals and the timetables, and the pre-sale planning stage more covers any potential issues that could be identified before taking the business to market and ensuring that we have a plan or that we've rectified those before that takes place. We then move into the information memorandum and financial forecast step. So the information memorandum is the document that presents the business to the potential buyers. It highlights the key business value drivers, both operationally and financially, and ultimately it highlights the market positioning as to why it's attractive to that potential buyer pool. Step 4, which relates to identifying the potential buyers, we do normally run this in tandem with step 3, and that is kind of the extensive market research that we undertake. It's looking at who the potential strategic trade acquirers could be, looking at kind of potential private equity route as well. And we do have some good recent examples as a corporate finance team of clients that have come to us and may have suggested that there are only a small number of potential buyers for their business. What we found in the process is that we've identified other parties that have either ultimately become the acquirer of that business or have become involved in the process, which has helped drive value through the competitive tension that John's referenced earlier. In terms of making the approaches, we do this through multiple channels. We do email, phone calls. We also utilize LinkedIn now as well. And all the information is shared under a non-disclosure agreement to help maintain that confidentiality. What we hopefully achieve during that process is that we're then in receipt of indicative offers, so step 6 there. We ensure that there's clear deadlines in terms of when we expect to receive the offers. We may facilitate pre-offer meetings with the shareholders so that each party can get to know each other a little bit better. But the ideal scenario for us after this step is that we're comparing and contrasting multiple offers to discuss the different aspects that we may like or not like, but we can use that to help drive value going forward. The heads of terms and due diligence phases, I know that Rebecca's going to cover in more detail shortly, so I won't go into those in too much detail. But once we get past that kind of negotiating the key documents and outlining the transaction, our role is very much project management, protecting that value through to completion, ensuring that's kind of a timely process. And we thought it'd be helpful to show kind of the timeline for all of these steps. As John touched on at the start, what we are seeing is that this is a 12-month process. There are steps that overlap, as you can see that in the graphic. However, from kind of month 1 through to month 12, that is kind of how we see the process working. So I'll hand over to Rebecca now, who'll touch on a bit more in terms of the legal aspects.
Well, thanks, Lewis. Hi, everyone. I'm Rebecca Jones, and I'm a senior associate in the corporate team at Beswicks Legal. So I'm firstly going to talk you through sort of the due diligence process and what it is and what it involves. So it's essentially an investigation by the buyer of the business that is proposing to acquire by asking a whole array of different questions on different topics relating to the business in question. And its aim from the buyer's perspective is to understand the business in more detail and its operations, discover any issues, potential liability or risk associated with the business, ascertain whether the elements of the business sort of meet the buyer's expectations on which it sort of based its original offer, understand any steps that are needed to integrate the business into the buyer's organisation if that's relevant, and identify sort of any steps that need to be taken before the sale takes place. Those could be sort of consents under financial facilities or under contracts, for example. It's really a crucial stage in the process for the buyer, who is essentially trying to ascertain whether the purchase will be sort of a sound commercial investment. And the findings of the due diligence operate as a key negotiating tool further down the line in the legal documentation. The extent of due diligence has grown over the years, so it's even more important now than ever to have that good advisory team around you, and to also ensure that if you're thinking about selling in 2 to 3 years, you're thinking, well, what do I need to do to prepare for that sale? Your advisory team will all help in sort of collating the information required for the due diligence and the supporting documentation. So the areas that are covered by due diligence are noted on the slides. So the first three, financial, tax and legal, are the main three that we tend to see. The remaining sort of topics are usually covered off under the legal, but depending on sort of the industry and the nature of the business, they can form standalone requests as well. So taking financial due diligence first, to give a summary of what that is, that's essentially looking at the key financial areas of the business that underpin the buyer's offer. So is the buyer's looking to assess the financial risks and opportunities of the transaction, and whether in light of the findings, the acquisition will fit into the buyer's strategy. It can also help quantify and identify potential synergies, so how the business will fit with the buyer in the buyer's organisation to create more efficient, positive results, and also the best financing and acquisition structure. You've then got tax, which is undertaken by the accountants and tax advisors. And again, that can go to structuring. So how does it need to be structured from a tax perspective? It also helps identify any tax liabilities that may be triggered from the transaction itself, and confirms ultimately whether or not the business is itself compliant from a tax regulation and law perspective. Alongside that, the legal due diligence will run, and this is undertaken by the two legal teams. So the buyer's legal team is essentially checking that everything is in place legally that should be within the particular business. And they're looking to seek out any legal risks associated either with the transaction itself or the business, which are sort of inherent in the business itself. Other areas that may be covered sort of by the legal due diligence would be disputes, financial arrangements, commercial contracts, intellectual property, things like that. Touching on the point about having an experienced advisory team, it's so important that the advisors within the team communicate effectively on the due diligence process. A lot of the outcomes and findings of the due diligence do flow through into the legal documentation, whether that's adding sort of additional liability to the sellers or otherwise. So that communication is key. So having that experienced team around you is crucial. If sort of issues do come out of the due diligence, which sort of is inevitable, then depending on the nature and risk of the issue and point, depends on the outcome really. So if an issue can be rectified before completion, then you'd look to do that on the sell side. Obviously that could impact on timings and the overall timelines for the sale process. So if you're sort of preparing for a sale well in advance, you'd hope that any significant or material issues would be identified and any rectification steps taken before the sale sort of kicks off. Some issues can result in additional liability, as I said, under the sale agreement, and it can go to price as well if sort of the issue in question goes to the underlying method or assumptions on which the buyers offered the original price, then they may look to renegotiate. That's where sort of your corporate finance advisors are key there for that negotiation and having those difficult conversations. As I say, each sort of advisor within your team will be looking to achieve the best outcome for you based on their experience in disposals and acquisitions. So ensuring that knowledge and expertise is key. In summary, sort of looking at the due diligence, I would say the key takeaways here are get sale ready. By this, I mean looking at your business through the eyes of a prospective buyer. What would you want to know if you were purchasing your business? Have, as John's already alluded to, have your contracts in place, plan for succession, and then when you get to the actual due diligence process, it should sort of ease the pressure off you and enable you to then continue effectively running the business to maintain that performance. Going back to the advisory team again, having that good team around you, they'll help you with the collating of documents, the responses, and hopefully they'll minimise the stress from you. Lastly, the information that you do provide during the due diligence process can actually act as a shield for sellers under the legal documentation and following completion. So again, it's essential that it's done thoroughly in order to give you that protection, which will in turn then protect the value that you're actually receiving as a part of the sale of your business. So that sort of summarises the due diligence process. I'm now going to provide sort of an overview of the legal side now. So a transaction will kick off, as Lou said, with the heads of terms. Heads of terms, essentially a written handshake. They set the tone for the transaction, contain the main commercial terms, including things like pricing, when you're getting paid, how, timelines and assumptions and conditions on which the buyer is willing to purchase your business. Heads of terms aren't usually legally binding, but they do create a sense of commitment and they do guide the subsequent legal negotiations. At this point, it's really important that you do bring in your legal team and corporate finance advisors. It's very difficult commercially to backtrack on something that you've agreed in the heads of terms without sort of good reasons. So again, that input and knowledge and expertise there will be invaluable further down the line. We then go to, so before the due diligence kicks off, we'd expect the buyer to be providing confidentiality undertakings, so a non-disclosure agreement. The idea there is you need to protect your business before you disclose information relating to it. It is ultimately your business until everyone signs on that dotted line. The due diligence then kicks off and gets underway, which we've already sort of explained. And alongside that, you'll be looking to the lawyers will be looking to negotiate the sale agreement. So this is the linchpin document, brings all the deal terms together, prepared by the buyer's legal team and negotiated by the sell side to make the terms more favourable to the sellers. Salient sort of provisions for sellers within that document, obviously pricing, when you get paid, how you get paid, on what terms you get paid. There's also liability that's placed on sellers within the sale agreement. So you may have heard of warranties. So these are essentially statements that sellers give to buyers about the business, various aspects of the business. So that may be, for example, there are no ongoing disputes. There's been no material change in turnover or profits since the last account date, that kind of thing. And they're essentially twofold. So it's almost like a second round of due diligence, buyers looking to identify any issues that perhaps haven't been discovered during that initial due diligence process. But they also do create potential liability for sellers after completion. So the buyers can bring a claim if one of those warranties was incorrect when it was given. Going back to having an experienced team, you can negotiate the scope of and qualify warranties. So again, an experienced legal team will be able to do that for you to limit your exposure, which again, in turn, goes to protecting the price that you're receiving. There are other sort of clauses within the sale agreement, such as indemnities. So as I mentioned, if a specific issue arises out of the due diligence, you may look to add additional liability within the sale agreement for a seller. Indemnities are very onerous provisions, and you'd only look to include them for specific issues or liabilities. So again, you'd want to be limiting your exposure as much as possible, only giving those where reasonable. So again, it goes back to having that experienced legal team with the knowledge and expertise of these types of transactions. Similarly, in share purchases, if you're looking to sell the company and the shares, sellers would give a tax indemnity as sort of standard, and that the aim of the tax indemnities is to apportion the tax liabilities of the company so that the sellers are liable for the period before completion, so when the company's under their reign, and the buyers for after completion. Again, that's a very specialist area, requires input from lawyers who deal with them day in, day out, and also tax advisors. So honing in on the importance to engage with those who've got experience. The common theme with all of that is that the sale agreement will be imposing liability on the sellers, but with that, you also do restrict that liability. And again, having lawyers involved that know the usual restrictions and can tailor restrictions to the transaction will pay dividends after completion, because it looks to protect your value and ultimately try and negate claims being made against the sellers following completion. The next stage as in the process is disclosure. So this is a crucial document for an exercise for the sellers, one of the most important, and its aim is to extinguish the liability of the sellers under the warranties and the sale agreement that I've mentioned. It's essential that it's done with care to protect price and liability, and it's much easier by being sale ready and having the right team around you. If you've gone through an efficient due diligence process that's been thorough and your house is in order, you know your business inside out, that will pay dividends at this stage. As a part of every transaction, there will be ancillary aspects, so documents ancillary to the main ones that will be negotiated and prepared and so on, alongside the main transactions. That might be approval-based documents, financing, security documents, change of control, approvals and things like that. So once all that's been prepared, negotiated and agreed, you'll be pleased to know that we then get to closing, which is when all of the documents are executed, it's facilitated by the lawyers, and that's when you get the consideration that you're expecting on day one. A sale can be sort of all-consuming, it can be intense, and it's really, really personal for sellers. So my sort of key takeaways for the process to reduce stress and maximise value will be to be prepared. It's never too early to get your house in order. Engaging with the right professionals will help you do that. And you'll also then be forging relationships with those professionals, which will ease and enhance the sale process when the time comes. And just engage the right people, those with knowledge, with expertise, whose approach aligns with yours, who ultimately you get on with and have confidence in and just feel that you can trust. So that brings my slides to an end. So I'll pass over to Terry, who's going to talk to you about protecting and growing the cash that you generate from the sale.
Thanks, Rebecca. So I'm Terry Hughes. I'm Director of Wealth Experts here, and what I've got here is a bit of an agenda to explain sort of who we are, what we do, and to give you an example of a client we've helped through the sales process and what comes next thereafter. So who we are, we're an experienced team of financial planners. We've worked alongside DJH now and their clients for nearly 20 years, primarily looking after business owners and other individuals. What we do, we like to think we help clients become financially organized. Going through a process like this, selling a business, is a huge transition for anyone. And it comes with a load of questions and a lot of uncertainty that we're hoping we can help answer. Typical ones are, when can I afford to go? When can I afford to sell the business? How much do I need to sell my business for? And can I afford to live the life I want after the process? There's obviously specific questions to do with the proceeds, what to do with the proceeds as well. Again, for a lot of business owners, their business is their baby. It's something they've spent years and years building, and suddenly to hand that over for a chunk of cash is obviously very sort of out of their comfort zone. So it's being able to work with them to manage that ultimately legacy for the rest of their lives, and to protect them and the rest of the family in that transition. How we work is we follow a tried and tested 6H process. And I'm going to talk you through that now. The first step is always what I consider the get to know each other meeting. We tend to sit down with clients and try and really understand where they are, how they've got to the point they're at, and importantly try and lay out what's going to follow and what their ultimately retirement or the next stage of their life looks like. If we think there's a good fit there, we'll take that into the discovery meeting, which is doing that in a bit more detail. And then quite often there's a period where we'll go away and work to analyse their current position, any other financial arrangements they've got alongside the business, and put together a bit of a plan, which I'm going to show you in a few later slides. Once we've got that plan together, we'll present that with the client, present that back to the client. It's very interactive. It's something we need to agree on. Obviously, different clients and different people have different plans for the future, and it's trying to get a tailored solution that works for you. Typically, there's always a bit of tidy up work to follow, which we can help with. And then importantly, we see this process as an ongoing process, not a one-off transactional process. Things change on a personal view. Things certainly change from our side. We're still awaiting a budget from Rachel Weaves. She's decided to delay it for a few weeks, but they tend to move the goalposts along, along the way. So it's trying to keep you on track. To give you an example of a client we have worked with, who's gone through and sold their process, I've obviously changed the name. I've got Alan and Norma example here. They were business owners of an engineering company and getting to that stage in their life where they were thinking about the next stage and how they exit. Their concerns were fairly common. They didn't know how much they needed from a sale. They didn't really know what they needed in retirement. And they were concerned that, they were going to run out of money at some point. So what we did with them, like we do with all of our clients, is we work with them quite closely, try and really understand them, and then use a bit of software to help to model their lives and turn all the complex things going around your head into something that's very simple and so very simple and being able to understand it. Again, I'm going to show that on the next slide. Following a sale, as I've touched on, most owners of business have obviously worked a long time to build a good business, and then to change that to cash. That cash is really important. It's going to last all the rest of their lives, probably be a legacy for their children as well. So it's really important to make the right decisions with those proceeds, tax efficiently for growth and things like that as well. So it's really working with a client after the sale has happened to make sure they don't run out of money, and they enjoy the life that they want to lead. So to give you a bit of an idea of what Alan and Norma looked like before we got involved, this is fairly common when we meet with clients. In this example here, I've got a few lines. I'm not going to go through them in too much detail, but you can see the business. It makes up the vast majority of their estate, of their wealth, which isn't uncommon. Most business owners are focused on growing that business throughout life. There are obviously some disadvantages to changing a business for a load of cash. Not least for inheritance tax. You get some reliefs for a trading business. Obviously, that disappears when you